In this video, we're taking a closer look at discontinued operations and how it is calculated. First, just to review, companies report there's three main types of income gain or loss when it comes to discontinued operation. The first bullet point there is the income or loss from the actual running of the operations. So you have revenues, you have expenses, and if you have more revenues than expenses, you're going to have income. If you have expenses that are too high, you're going to have losses. The second piece is related simply to the plant assets themselves. You can either be holding them on the last day of the year, the last day of the period. In that case, you have to remeasure them to fair market value less any disposal costs. So you compare the carrying value to the fair value and you determine if you have a gain or loss. The next piece is gain or loss on the disposal if you already sold it. So that's really easy to figure out. Let's take a look at two quick examples to show us what we're supposed to do here. In this example, JoJo had a discontinued operation. JoJo Incorporated is still holding the assets as of year end. They have determined that the operating loss from discontinued operations was $500,000 for the period. And then they also looked at the plant assets and discovered that the net assets had decreased in fair value by $272,000. That wording signifies to me is that they actually measured it at fair value at the end of last year, and since then the amount has even decreased slower than that. So the tax rate is 30%, and they're asking us to prepare the discontinued section. So what we're going to do is we're going to show each of our two items that go into the discontinued gain or loss. We're going to show them both net of tax, and then we're going to sum them up. So we actually said that it was $500,000 was the operating loss. So the tax benefit in that case, it saves us money, is 30% times 500,000. So it's 150,000 is saved. The overall loss there is 350. When it comes to the actual plant assets, we take the decrease in fair value 272, and we're simply taking out the tax benefit there, and so it ends up being you could multiply 272 times 70% and you get the answer. So fairly straightforward. We're going to look at one more. In this case, it's a little bit different. They committed to a plan on October 1st to discontinue the beverage segment, and they sold it within the same year for a loss of $168,000. One other thing that's different about this one is that they committed to the plan on October the 1st, and then it was sold before the end of the year. So think about it this way, is that between January 1st and October 1st, the operations were running normally, and after October 1st is when we knew it was being sold. We add the two sums together, and then we go ahead and show that at 80%, remember it's net of tax, 20%. In your second line, you're going to look at that loss that we had of $168,000. That did actually give us a net of tax benefit, so it reduced our taxes by having that loss. So we're going to again take the 168 times 80%, and that'll show us our net of tax benefit. We combine the two for an overall, it's going to be a gain on discontinued operations, and that's all there is to it.